Last year, the volume of food recalled by the FDA, it actually more than doubled.
Wow, more than doubled.
Yeah, more than doubled. And just to put like a real dollar figure on what that actually means for the companies involved, there was a recent infant formula recall that is expected to cost Nestle a staggering $350 million in lost sales.
Which is just wild because, that 350 million is literally just the lost revenue.
Right, it doesn't even count the cleanup.
Exactly. I mean, it doesn't even touch the logistical nightmare or the immense costs of physically retrieving those products from shelves all across the country. Plus, managing the PR fallout, investigating the root cause. The stakes in this industry are just incredibly high.
They really are. So welcome to the deep dive. Today our mission is to unpack the Q3 2026 earnings report of a company called Neogen, ticker symbol NEOG.
Yeah, they're kind of a quiet giant operating in the background of the whole food and animal safety industry.
Exactly. And our goal for you today listening is to look right past all that dry financial jargon. We want to understand how a company that's essentially responsible for keeping our global food supply safe is navigating, well, some severe supply chain chaos.
Yeah, and major geopolitical headwinds, not to mention a massive internal transformation they're going through.
Right. Because Neogen is it's just a brilliant case study of the modern economy. Their whole core mission is to provide stability and safety to food producers,
But as an operating business themselves, they are totally vulnerable to the exact same unpredictable, macroeconomic forces that their clients are facing.
exactly, they have to engineer resilience from the inside out.
Yeah,
So let's start with the top line numbers, because at first glance, they paint a pretty positive picture.
they do, yeah.
For Q3 2026, Neogen beat market expectations. They posted $211.2 million in revenue.
Which is a solid beat.
Definitely. And they beat earnings per share estimates by coming in at 9 cents. They even felt confident enough to raise their full year 2026 revenue guidance. So now they're expecting between $857 million and $860 million.
And, I mean, raising full-year guidance in the current economic climate we're in, that sends a really strong signal of internal confidence to the market.
For
So
sure.
it basically tells investors, hey, we aren't just surviving this quarter, we actually see a clear path forward.
Right. But okay, let's unpack this a bit more, because diving deeper into the actual transcript of their earnings call reveals a much more complicated reality.
Oh, absolutely.
Their performance this quarter kind of looks like a two-engine airplane in mid-flight, where one engine is just roaring beautifully and the other is visibly sputtering.
That's a great way to put it.
So let's look at the roaring engine first. Their food safety segment grew by 4% on a core basis, meaning organic growth, not driven by acquisitions or anything.
Right.
And that was fueled by a massive 11% spike in what they call indicator testing and culture media.
Yeah, and for those not deep in the biotech weeds, culture media and indicator testing, they are really the bedrock of food safety.
Right. Explain that a bit. What is culture media exactly?
So a culture medium is essentially this nutrient-rich gel or liquid, and it's designed specifically to support the growth of microorganisms.
Okay.
So when a food producer swabs a surface in their factory or tests a batch of ground meat, they place that sample into the culture media. If harmful bacteria like, say, E. coli or Listeria are actually present, the media allows them to multiply really rapidly until they become visible.
Ah, so it basically lights up the problem before the food ever leaves the facility.
Exactly. It's an early warning system.
Okay, so an 11% spike in that specific area shows that food producers are testing more aggressively than ever.
Definitely. The demand is surging.
But then we look at the sputtering engine. Neogen's animal safety segment saw core revenues decline by 8.7%.
Which is a significant hit.
Yeah, it's huge. And my first instinct when looking at an 8.7% drop for such an established company is, well, they must be losing ground to a rival. Like, did farmers and ranchers suddenly just switch to a cheaper competitor? Or did demand for animal safety products just dry up?
You would totally assume it's a sudden loss of market share, but the underlying data paints a very different picture. The demand for these products was completely intact.
Really?
Yeah, farmers still desperately needed these safety solutions. That 8.7% decline was almost entirely a supply-side failure.
Wait, so Neogen had willing buyers lined up, cash in hand, but they physically couldn't put the products in their hands.
That is the reality, yeah. Neogen's CEO, Mike Nassif, he addressed this head-on during the call. They rely on third-party manufacturers for a portion of their animal safety portfolio.
Okay.
And they were just hit by this compounding series of disruptions from those partners. It was basically a perfect storm of supply chain failures operating completely outside of Neogen's direct control.
Wow. But, supply chain disruption can mean literally anything,
Yeah.
from a late truck to a factory burning down. What specifically broke down in their network?
It was actually three distinct, overlapping crises that hit them all at once.
Oh, man. Okay, what was the first one?
First, a key supplier for their analytical instruments is currently attempting to relocate their manufacturing facilities, specifically to avoid international tariffs.
Oh, of course. Tariffs.
Right. And transitioning a highly technical manufacturing line is incredibly complex. This supplier has just been plagued with startup challenges at the new facility, which created a massive bottleneck for Neogen's instruments.
So geopolitical trade policies are literally stopping Neogen from getting the testing instruments they need to sell.
That is the first hurdle, exactly. The second issue is biological. There is currently a severe global shortage of vitamin A.
Vitamin A. Like the supplement.
Yeah, but in the animal safety world, vitamin A isn't just a daily gummy vitamin. It is a critical raw material.
Oh, interesting.
Yeah, it's an essential component that gets formulated into injectables and feed additives that support livestock immune systems, their vision, bone growth, especially right before breeding seasons.
Wow. Okay.
So without that raw material, Neogen's partners simply cannot manufacture the finished products.
That makes sense. And the third crisis.
The third crisis involves a major partner who supplies sodium bicarbonate.
Wait, sodium bicarbonate, isn't that just baking soda?
It is. It sounds like a basic baking ingredient, but at a commercial agricultural scale, it's absolutely vital. Dairy cows eating high-grain diets, they frequently suffer from rumen acidosis.
Rumen acidosis, what is that?
It's essentially severe, life-threatening heartburn for cows.
No way. Cows get heartburn.
They do, and it's a huge issue. So sodium bicarbonate is this massive volume antacid used to treat it. But Neogen's partner for this product went through their own internal transition issues, severely choking off the supply.
That is wild.
Right, so you combine tariff evasions, raw material shortages like vitamin A, and partner facility transitions, and you get massive back orders, higher scrap rates, and boom, an 8.7% drop in division revenue.
It's genuinely startling to realize that a high-tech bioscience company can have its entire quarter dragged down.
Yeah.
Because a completely different company couldn't source antacid for cows or figure out how to move a factory.
It really highlights how interconnected it all is.
Definitely. But if Neogen's third-party suppliers are getting hammered by these global macro events, Neogen itself must be facing those same headwinds internally, right?
Oh, absolutely. The global landscape is intensely volatile right now, and Neogen's executives were very transparent about the pressures they're facing. The operating environment for the massive food producers, companies Neogen cited like Conagra and General Mills, it has deteriorated significantly.
Yeah, the major food producers are citing the conflict with Iran, skyrocketing fuel and fertilizer costs, and the ongoing shipping disruptions in the Suez Canal.
The cost of physically moving goods around the planet is just ballooning right now.
Right. And food safety testing requires physical kits, specialized plastic components, and this massive global logistics network. If the world is dealing with soaring oil prices and Neogen relies heavily on plastic components, which are literally derived from petroleum, isn't a company like this just highly exposed to oil shocks?
Analysts raised that exact concern on the call because when the cost of crude oil spikes, the cost of manufacturing plastic usually follows right behind it.
Makes sense.
However, Neogen CFO Brian Rigsby, he explained this structural defense they've built into their supply chain. Neogen purchases roughly $40 million annually in plastic OEM, or original equipment manufacturer, components.
Okay, $40 million in plastic. That's a lot.
It is, but they don't buy them just in time. They currently hold 6 to 9 months of inventory for those specific critical plastics in their warehouses.
So they basically have a massive stockpile, just a giant warehouse of physical material to ride out short-term spikes in the oil market.
Pretty much, yeah. They have essentially decoupled their immediate raw material costs from the daily volatility of the energy markets. Oil prices would have to remain elevated for the better part of a year before it meaningfully impacted their manufacturing cost structure.
That's actually super smart.
It is. But holding inventory doesn't protect them from everything. They still have to physically move the finished goods to the customers, and that is where they are feeling the immediate pain.
Right, the global logistics side.
Yes. Freight and transportation costs are up in the high single to low double digits across the board.
Yikes. So in terms of their actual balance sheet, what does a low double-digit increase in freight actually cost them?
It adds an extra $1.5 million in incremental cost per quarter just to physically move their products.
Just on shipping alone. Wow.
Yep. Additionally, they're battling shifting foreign exchange rates. When the US dollar is particularly strong compared to other global currencies, the revenue Neogen generates in Europe or Asia, it translates to fewer US dollars when they report their earnings back home.
Right. Standard FX
Yeah.
issues.
Yeah, and this exchange rate dynamic has shifted from being a benefit a year ago to a significant headwind today.
Okay, so let's look at the board so far. We've got an 8.7% drop in a major division caused by third-party suppliers fumbling their manufacturing. We've got an extra $1.5 million bleeding out every quarter in shipping costs alone, and international currency rates just eating into the revenue.
It's a tough environment.
It is. If you're Neogen's leadership team looking at this level of external chaos, the logical response is that you can no longer trust other companies with your core business. You have to stop renting manufacturing space and start owning the factory yourself.
Exactly. And this is the driving philosophy behind the most critical element of Neogen's transformation, the insourcing of Petrifilm.
Petrifilm.
Yeah.
That seems to be the linchpin of their entire long-term strategy here. For you listening, Petrifilm is their crown jewel indicator testing product. If you've ever seen a food safety technician testing for E. coli, salmonella, or coliforms, they're very likely using Petrifilm. It is the industry standard.
Oh, totally.
But historically, Neogen hasn't actually manufactured this product themselves, right? They relied on a third party. And now they're in the middle of a massive project to bring 100% of this manufacturing in-house by November 2026.
And you really can't overstate the scale and technical difficulty of replicating a specialized biological manufacturing process like this. But, I mean, they are executing it with remarkable precision.
How so?
Well, by the end of Q3, Neogen had successfully validated 100% of the production equipment at their new facility.
Wow, 100%.
Yep, they're now actively running operational performance validations on their top 17 Petrifilm SKUs, which stands for stock keeping units, basically the distinct variations of the product tailored for different types of tests.
Here's where it gets really interesting to me. Think of Neogen's historical arrangement with Petrifilm, kind of like trying to bake a highly customized, intricate wedding cake, but you're forced to use a massive commercial bakery that only lets you press the standard chocolate or vanilla buttons.
That's a perfect analogy.
Right. On the earnings call, CEO Mike Nassif noted that for years, massive enterprise clients would approach Neogen asking for custom Petrifilm products designed for their specific manufacturing environments. And Neogen had the scientific recipes for these custom tests, but they didn't own the oven.
Yeah, they had to turn those clients down because their third-party manufacturer just wouldn't accommodate custom, smaller batch runs. It wasn't worth their time.
Right, so the inability to iterate and customize was just this structural ceiling on their revenue growth. But by insourcing the production, they removed that ceiling entirely.
They finally own the oven.
They finally own the oven.
They do. And the strategic brilliance of this capital investment, it works on two distinct levels. First, as Nassif pointed out, building this specialized factory requires such profound technical expertise and hundreds of millions of dollars in capital that it creates an almost insurmountable barrier to entry.
Oh, that makes sense. A boat.
A massive moat. Smaller startup competitors simply cannot raise the funds or replicate the science to build a competing factory. It heavily fortifies Neogen's dominance in the market.
But the second level of this strategy is what actually opens up the new revenue streams, right?
Yes. The growth potential is massive because as part of this transition, Neogen is building a dedicated research-scale R&D manufacturing line at a facility in Minnesota, which is slated to come online in Q4 2026.
Why build a completely separate line just for research?
Because it allows their scientists to rapidly prototype, test, and validate those highly customized testing films without ever needing to interrupt the massive, high-volume commercial production lines at their main facility in Lansing.
Ah, so they can tinker without stopping the money printer.
Exactly. And once you have the infrastructure to prototype custom biological tests efficiently, your market is no longer restricted to just testing ground beef and poultry.
The applications for microbial testing go far beyond the grocery store.
Way beyond. They extend into highly lucrative consumer and industrial markets. We're talking about pharmaceuticals, cosmetics,
Oh,
nutraceuticals.
wow. Cosmetics.
Yeah, think about it. A contaminated batch of face cream or daily vitamins is just as dangerous as a contaminated piece of chicken.
That's a scary thought, but very true.
Right. These are industries where absolute precision and biological safety are paramount, and crucially, these are industries with very deep pockets willing to pay premium prices for custom testing solutions.
So insourcing Petrifilm fundamentally changes what Neogen is capable of selling. It's a whole new ballgame.
It really is.
But taking on a project of this magnitude brings us to the financial reality of the situation. Building dedicated R&D lines in Minnesota, validating an entire factory's worth of equipment in Lansing, overhauling a global supply chain, it all requires an immense amount of capital.
Definitely.
If freight costs are eating their cash and third-party delays are hurting revenue, how are they paying for all of this without leveraging the company to the point of bankruptcy?
Well, to fund this transformation and maintain a healthy balance sheet, Neogen had to make a difficult but highly strategic decision to shed some weight. They announced an agreement to sell off their genomics business unit.
Okay, for how much?
The sale price is $160 million, which will net the company approximately $140 million after taxes and transaction fees.
See, selling a business unit that generates around $90 million a year in revenue, that seems like a pretty drastic move, especially when the CEO is simultaneously talking on the call about strictly, quote, scrutinizing spending across the company.
It does seem drastic on the surface.
And there was one specific metric they shared that really gave me pause. Currently, 56% of Neogen's operating expenses are tied directly to salaries and benefits. Over half of the money it takes to run this company goes to human labor.
Yeah, 50% is a big number.
It is. So are they stripping the company down and selling off major divisions just to pay down debts they can't afford? Or is this part of a larger modernization strategy?
It is absolutely a modernization strategy, and the sale of the genomics unit highlights a really disciplined approach to capital allocation. The genomics division, while generating revenue, it operated with much lower profit margins than Neogen's corporate average.
So it's a kind of a drag on their overall profitability.
Exactly, and it was highly capital intensive. By divesting it and applying that $140 million directly to their debt, they anticipate bringing their net debt to adjusted EBITDA ratio below 3 times by the end of 2026.
Okay, for context for you listening, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's just a standard way to measure a company's core cash profit. So a ratio below 3 times means their total debt will be less than 3 times the amount of cash they generate in a single year, which is a very healthy benchmark for a company of this size.
Right. The balance sheet becomes significantly stronger the moment that deal closes. But your observation about the 56% operating expense tied to salaries, that cuts to the core of the new executive team's mandate.
Really? How so?
CEO Mike Nassif stated bluntly that having over half of your operating expenses tied to manual labor and administration is a direct symptom of historical underinvestment in process automation.
Okay, so they essentially have hundreds of highly paid employees doing repetitive administrative tasks that software should have taken over like a decade ago.
Bingo. The new leadership team, which includes Nassif and the newly appointed commercial leaders Tammy Rinaldi and Joe Friels, they recognize this inefficiency and are actively pivoting the entire corporate culture.
What were they doing before?
Historically, Neogen operated as a collection of regional silos. A sales team in Europe might use completely different software and strategies than a team in South America. The data wasn't integrated, which required literal armies of administrators to manually reconcile everything.
That sounds like a nightmare.
It was. Rinelli and Friels are dismantling those silos, shifting the company to a unified global solutions-based model.
They mentioned moving away from direct sales in certain regions too, right?
Mm-hmm.
And relying on distributors instead.
Yeah. If a specific regional market isn't generating enough profit to justify the massive overhead of a dedicated internal sales team, they will transition to a distributor model, which dramatically cuts their salary liabilities in that region.
That makes total sense.
But the ultimate solution to that 56% salary bloat is their aggressive investment in artificial intelligence and automation.
Now that's interesting, because how does a bioscience company practically deploy AI to cut administrative costs. We're not talking about AI inventing new drugs here.
No, it happens in the back office and the supply chain. Instead of employing a team of 50 people to manually track spreadsheet data for shipments of, temperature-sensitive lab equipment crossing dozens of borders with varying tariffs,
Which sounds incredibly tedious.
extremely tedious and error-prone, they are implementing AI-enabled logistics software instead. This system automatically reroutes shipments based on global bottlenecks, reconciles complex international freight invoices in real time, and manages inventory forecasting. Yeah, they are automating finance processes and end-to-end supply chain visibility. The goal is to replace manual, error-prone administrative labor with intelligent systems.
Shrinking that 56% cost structure without having to fire a single scientist or product developer.
Exactly. You protect the core innovators and automate the paperwork.
And we can actually see the proof of this cost discipline working in this exact quarter. Because despite the absolute chaos with the animal safety suppliers we talked about, and despite bleeding an extra $1.5 million a quarter in freight costs, Neogen's adjusted EBITDA margins, their core profitability hit 22.8%.
Which is fantastic.
Yeah, that is a 110 basis point improvement from the previous quarter.
And, 110 basis points is financial speak for a 1.1% increase. In the context of a company generating hundreds of millions of dollars, a 1.1% margin expansion during a period of intense global supply chain pressure, that is a phenomenal achievement.
They managed to shrink their overall operating expenses by 9% sequentially from the previous quarter.
Incredible.
Trimming the fat, automating the logistics, paying down debt with a genomics sale, it's creating immense financial leverage. Even when their revenue growth slows down or certain divisions face headwinds, their underlying profitability just continues to rise.
It demonstrates that the executive team has total control over the levers they can actually manipulate. They can't control the Suez Canal or the global price of vitamin A, but they can control their internal software, their debt ratio, and their own manufacturing infrastructure.
Let's pull all of this together for you listening. We started off looking at what appeared to be a standard, relatively positive earnings report. But digging into the sources revealed a company executing a high-wire, massive internal turnaround.
Truly massive.
On one side, Neogen is battling external forces completely out of their control. Third-party suppliers failing to navigate tariffs or source basic antacids for livestock, global shipping lanes turning into a logistical nightmare, and international currency fluctuations eating away at their profits.
But on the other side of the ledger, they are aggressively redesigning their entire business model to insulate themselves from that exact chaos.
Exactly.
They are executing one of the most complex manufacturing insourcing projects in the industry by taking full ownership of Petrifilm. That move not only secures their core product line, but creates the infrastructure to design custom diagnostics for the pharmaceutical and cosmetics industries.
Right. And they're making the hard choice to sell off a $90 million genomics division to pay down debt. And they are tearing out outdated, human-heavy administrative processes and replacing them with global AI-driven logistics.
The result is a leaner, far more resilient company operating with incredibly healthy profit margins. It's a testament to the fact that in modern business, true stability isn't about avoiding disruption. It's about engineering a system capable of absorbing the shock.
I love that. Engineering a system to absorb the shock. But as we wrap up this deep dive, I want to leave you with one final concept to consider.
Yeah, the transition we are seeing here points to a much larger shift in how we handle global resources.
Throughout this entire analysis, we've seen how physical, tangible disruptions dictate the safety and availability of the food you eat. A change in tariff law, a blocked shipping canal, a shortage of a single vitamin, these physical events ripple through the supply chain. But consider what Neogen's aggressive pivot toward AI and automated supply chain software really means for the future.
It's a paradigm shift.
It is. We are rapidly moving away from a world where humans manually test a batch of ground beef or a piece of poultry after it's been produced to see if it happens to be contaminated. We are moving toward a highly integrated future where artificial intelligence and predictive supply chain data might anticipate a pathogen outbreak based on weather patterns, freight delays, and supplier histories before a single seed is even planted or an egg is hatched.
Which is mind-blowing.
It really is. So the question is, in a fully automated, AI-driven global agricultural system, who truly controls the invisible infrastructure keeping us safe? Is it the scientist holding the physical testing swab, or the algorithm predicting the risk from a server halfway across the world? Consider the vast web of technology making that safety possible the next time you drop a box of cereal into your grocery cart.
Something to think about.
Thank you so much for joining us on this deep dive into Neogen. Keep asking the big questions, keep looking past the surface of the data, and we'll see you next time.